Welcome to the Organized Investor PodCLASS with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. Think of these pod classes as a college of knowledge, and the curriculum is an inside look at how we work with our clients to organize their investments, their retirement, and their affairs. Our process is certainly not the only approach, but it has served our clients well. Listening may materially improve your life as well, but for that to happen, it also takes an open mind, an interest to learn, and your trust in what we're sharing. We focus only on what is relevant and will explain things several times in different ways over multiple classes to ensure you understand their importance. We suggest you subscribe so you'll receive reminders about the next class. And with the tools and information on our website, theorganizedinvestor.com, you can start getting organized right now.
Hi, listeners. Thanks for joining us today for PodClass number 12, which is the sixth in a series about how to organize your investments. And that includes our goal to materially improve the financial lives of our clients. In PodClass 11, we actually shared what we feel are impressive performance numbers for the 190 advisory accounts we currently manage. Now, with that in mind, think of your own portfolio as a lottery ticket because, you may have some room for significant improvement, but you have to check on it to find out, right? If you get a winning lottery ticket, you have to check the numbers. So we're going to continue to cover that. And also we're going to revisit the mediocre performance of a mutual fund advisory account that may be similar to what's in your own investment portfolio.
And listeners, for the first time ever, we're going to discuss what is termed pay-to-play arrangements. This between probably your investment firm and a lot of product and service companies that they may be recommending. Now, this is just one more reason why we try to avoid advisory accounts that are invested in either mutual funds, exchange-traded funds, maybe even both. And if you haven't yet noticed, we're covering a lot of information that your financial advisor, either they don't know or they just are not going to tell you because they don't want you to know.
Hello again. It's still me, Megan Hubbard, and along with my dad, who is still Jerry Goodman and who you just heard speak for just a second, we are still, I guess, whoever we are, but we're here and we're glad you're able to join us today. So again, as we've said in previous pod classes, if you've listened to us, think of us as Megan and Dad. I'm a former first grade teacher at Christian Academy of Knoxville, and Dad realized at an early age that being last can sometimes actually be better, particularly when you're on an elevator.
Exactly.
So I have a master's degree in curriculum and instruction, and Dad has 43 years of stories, experiences, and he is the funniest father I have. I mean, he's the only father I have, so I guess he can wear that with a badge of honor.
Yeah, would that also make me the least funny father you have?
Very good point. Yes.
Yeah, that's what I was thinking. But as Megan just mentioned, this is the sixth in a series of how to organize your investments. And we have the goal overall to try to improve your overall performance. By how much? 2% a year. Let's just start off from there. Now, we emphasize the word improve your performance because what we're referring to is 2% more than whatever you have been getting in the past.
And we've been dissecting that 2% improvement in several different ways. So, first, what if you could save maybe 1% on an advisory fee and investment cost? And, what would that benefit be? Next, what if you could improve your actual investment performance by another 1%? And how much would that benefit you? And then your actual benefit actually depends on how your portfolio is currently invested and, just how big it is. But for someone with $1 million portfolio, let's just consider that as, an example here. A 2% improvement is actually equivalent to an additional $20,000 per year on top of their current return. That is not a small number, my friends.
It's a chunk of change.
Yes. So, being that is a lot of money and it's equivalent to $400,000 if you extrapolate that over the next 20 years, this is not something to turn your nose up at or turn your ears off, as I might tell my first graders. Why are your ears turned off? You're not listening to me. So turn your ears back on and, listen to what we're saying, because this is important.
And before the day is over, the word of the day challenge for you is to figure out some sentence that you can use to use the term extrapolate. I don't know why I thought it's a cool word, but anyway, unfortunately, what Megan is talking about, it can be kind of hard to visualize, how much the benefit might be from, if this or if that happens. It may be even a little confusing. So in the last pod class, what we started doing was explaining the 2% improvement from a 180-degree different direction. Now, to do that, we took the time to have to compile the historical rates of return for all of the 190 advisory accounts that we currently manage for clients. And the data was through month ending January recently of 2024. So out of those 190 accounts, there's 87 of them that have been managed for at least 5 years. And the net rate of return was 14.06% per year. So we'll call that 14% over that 5-year period. And just to be clear, the term net rate of return is after any cost or fees were incurred. So it is actually what the clients received in net dollars over that 5-year period.
And if you extrapolate that 14% return for 5 years,
word of the day, by the way. Sorry.
Pause. Do I get like bonus points? Because I've used that word twice.
Yes. It may not be the last time, but yeah, continue. Sorry.
So again, if you extrapolate 3 times there, people, that 14% return for 5 years, it's actually equivalent to a 92% increase, which is not a double in value, but it sure is close, right? So these numbers are through month ending January of 2024. And in PodClass number 11, we also covered the net rate of return for the last 1 year, 3 years, 10 years, and, since each account was actually incepted. So to help you remember at least one of these many numbers, we decided to focus on the 5-year net rate of return because it's short enough to include a total of 87 accounts, but also long enough to have a historical data that is actually meaningful.
So this 14% net rate of return for that 5-year time period, what does that mean? It means that it already reflects our advisory fee that is probably lower than what you may be paying through your current advisor. It also reflects the fact that we try to avoid mutual funds and exchange-traded funds to just reduce the cost and also to improve the performance. It also reflects the fact that we're very selective with our investment choices and try to focus on stocks with a history of raising their dividends because of the exceptional returns for these types of stocks. So that is what these 87 accounts have experienced over that 5-year time period.
If you're wondering if it's possible to improve your overall performance by 2% per year, ask yourself these questions. If your portfolio had realized at a 14% net annual return over the last 5 years, would that be a 2% improvement for you? Many would say yes, because I didn't make anything near 14%. But if you don't know what your return was over the last 5 years, then did your portfolio almost double in value over the last 5 years? The performance our advisory clients experienced was equivalent to an increase of 92%. And granted, it didn't double in value, but it sure was close. Now, if you don't have any idea what your performance has been, you need to look. You're the ultimate decision maker about who's managing your investments. So maybe you need to take a minute and find out.
And depending, of course, on how you're currently invested, you may very well have the possibility of even more than a 2% improvement. Also, because the possibility we're discussing and the amount of money that may be involved here is so much, the fact is, as Megan mentioned a few minutes ago, think about your portfolio in a way, call it like a lottery ticket, if you will, okay? In the last pod class, we talked about some poor soul in Florida who had a $36 million mega lottery ticket where it was purchased at a Publix grocery store, but it never was redeemed because obviously they didn't know it had a winning number. So bye-bye to $36 million because someone didn't take the time to just check. And a lottery ticket, this may seem like a kind of a silly comparison, but it's the perfect metaphor to your portfolio.
So the person in Florida already had the lottery ticket, but it was up to them to find out if they had the winning numbers. And they didn't, and now it's too late. But assuming you have some sort of investment portfolio, it's also up to you to find out if your investments have been the winning numbers that might materially improve your financial future. Granted, it probably won't total $36 million,
That'd be
but
nice, wouldn't it?
that would be nice. Who knows? Maybe. You got to check, right?
Yep.
But your odds of improving your portfolio are much better than 1 in 302 million chances, right? Like, I feel like your odds are way better of improving than winning the lottery. So, in case you're wondering, just how much better are the odds? The answer is it really doesn't matter, okay? It doesn't matter about the odds because what we're talking about here is a portfolio of investments you've already owned, right? Like this is already in your possession. You already have the winning lottery ticket per se.
Basically, what Megan is saying is there's really not any downside risk to doing a little investigating and making a few comparisons, assuming you're willing to spend a little bit of your time. And if you're not even willing to spend a few minutes, then this is not rhetorical. This is not a question. Why are you listening to us talk about all of this? Okay. Look, we're glad you're listening. And I would consider that we're relatively entertaining, at least we think we are. But what we're covering in these pod classes can be a little bit on the technical side. It's not exactly like all fun and games. And it's designed to help you. But you also have to help us to help you because we have no idea what your portfolio looks like.
And it's not that time consuming, honestly. And about half of everyone we meet with has some portion of their portfolio with room for significant improvement. But unlike a lottery ticket, you can't check the TV or the internet to see if your portfolio has the winning number. And I'm pretty sure you don't want your portfolio on the internet or on television.
Probably not.
Probably not. So if you don't check, though, you may be leaving tens of thousands of dollars on the table.
So how do you find out? Well, there's a couple of things you can do. You can ask your current financial advisor. But think about that. This is the person that recommended your portfolio to look like this in the first place. Okay. You can ask a friend if you don't mind them kind of seeing what your personal affairs look like. You can try to do this yourself, or you can try to do it yourself with us helping you along the way.
And here's a really big clue, okay? The most likely place to find possible improvements is when your advisor has you in an advisory account that owns either mutual funds, exchange traded funds, maybe even both. There's several $1 trillion in these types of investments, and some of it probably belongs to you. So to improve that, to prove that same point, I should say, we covered this in podcast number 11. And, once again, we're going to compare the returns of the mutual fund advisory program called Fund Source, FUND Source, with the performance our clients have experienced.
Now, the track record that we're sharing is for an aggressive growth model of Fund Source. So that is an indication it's the most aggressive model that Fund Source has. This is offered through Wells Fargo advisors, and we have the track record for that particular model. I think it's through December 31st. It's on the investments page of our website. So take a look at it if you get a chance. Now, keep in mind that the returns in that summary, they're before any type of an advisory fee that's been deducted. So they're gross returns, not net returns. And since the rate of returns for our clients, those are net returns after all fees and expenses, we're going to deduct and assume, let's just say 1% advisory fee from these Fund Source returns in order to make this a fair comparison. We're comparing apples to apples here.
So we'll go through these one at a time here, okay? So the 3-year track record of Fund Source after assuming a 1% advisory fee is 2.47% per year versus our 3-year net return of 9.99% per year. So in other words, 9.99% is the net 3-year track record our clients have experienced and is 300% more return than Fund Source.
Is that all?
That's all.
Sure.
The 5-year track record of Fund Source, assuming a 1% advisory fee, is 8.92% per year versus our 5-year net return of 14.6%, which is 57% more than Fund Source. Now, the 10-year track record of FundSource, after assuming a 1% advisory fee, is 5.78% per year versus our 10-year net return of 9.6 per year, which is 66% more than FundSource. Now, keep in mind that for FundSource and even the DSIP list strategy we focus on, past performance obviously doesn't guarantee future results. Also, the FundSource returns are through December 2023, and our client returns were calculated through the end of January 2024, which is just a month later.
So as you try to digest all of that, the question may be in your mind, so why are the returns for our clients, why are they so much higher than the FundSource returns, this mutual fund advisory program? Well, part of it is because the FundSource strategy is invested in mutual funds with this particular situation, a hefty internal cost of 0.79%. Okay. Now that means someone with $1 million in this particular FundSource model is subjected to a cost of $7,900 per year. And that doesn't even account an advisory fee. That's just the internal cost of those 14 or so funds inside the FundSource model. Also, FundSource has about 14 different mutual funds, which it means it owns several thousand companies. If you kind of do the math on that, each one of these funds may own several hundred stocks, which may mean total several thousand stocks that you actually invested in. So when we think this, now we think, if you look at the math on this, this goes from being diversified to what we call diversification.
Dun, dun, dun.
Thank you. I thought you were going to miss that because you effectively, by doing this, you own like almost every stock on the planet. Now, by comparison, what we focus on are higher quality companies that have a history of raising their dividends, many of which are on this Wells Fargo research list called DSIP. And oh, by the way, the track record of this DSIP list is 12% a year going back to go back 30 years to 1993, I believe. So and that track record is also on our website if you want to take a look at it. Fabulous returns.
So there are very significant differences in the returns our clients have experienced versus the FundSource example. And you don't have to be a brain surgeon to realize which one would have made you more money, right? I feel like my first graders could have figured this out if I had given them these numbers. So, in fact, this can be a huge opportunity for many investors. And it's why we feel that you're very lucky to be listening to this explanation. That's because if you're invested in a similar approach as this FundSource mutual fund model with this same type of underperformance, you're that person we've been referring to. Your portfolio may have the winning number because your overall improvement may be even higher than the 2% goal we've even been discussing here on this podcast.
Now, there may be some of you out there that might be invested in something similar to this FundSource example that might even have a better return. If that's true, congratulations, seriously. But this FundSource example that we just covered, the returns off of this, that is similar to what we usually see when people send us their information to take a look at. So will this DSIP list that we use and our approach will always be a better strategy? Who knows? But we do know which ones we're going to be suggesting to our clients, for the foreseeable future until something were to ever change about that.
And in terms of our approach, we've mentioned in several PodCLASSes that these accounts are managed on a discretionary basis. But, what does that really mean? We can say that, but you might be thinking, well, okay, great. Tell me what that means. So with our broker dealer, we're classified as a portfolio manager. That's a tongue twister. This actually allows us to manage client assets for an advisory fee within certain rules and guidelines. And that means for certain advisory accounts, we have the flexibility to make adjustments to holdings in a timely manner without having to discuss it with our clients.
And in reference to what Megan just said, if it were not for that capability to manage this money kind of in a quick and flexible way and effectively, those rates of return wouldn't be as good as they are. Okay, that 5-year net return wouldn't be 14% per year through the end of January 2024. And that's because it simply would take a lot of time to contact 190 clients if we had to get approval to make all of these adjustments. Plus mutual funds don't call their clients to get an okay to make a change, and neither do we. That's not to say that we won't have a periodic discussion with clients about things from time to time, but it's not an everyday event.
You're listening to an Organized Investor PodCLASS, which makes up our College of Knowledge. Your hosts are Megan Hubbard and her favorite father, Jerry Goodman. You'll benefit most by listening to at least 12 PodCLASSes. And the best way to be reminded is to subscribe on your favorite podcast platform.
Many mutual fund advisory accounts, like the FundSource example, are also managed on a discretionary basis. So if you're invested in that type of account, it means you won't be contacted to give permission to make adjustments in your account. The firm will simply make those adjustments to the various mutual funds by maybe selling 2 funds here or there and replacing them with 2 different funds. But let's revisit again what we discussed in PodCLASS number 9.
And what Megan's talking about was we explained that instead of managing the advisory accounts for their clients, many advisors will simply turn that account over to their company to make all of these decisions for them. For example, an advisor who has clients invested in a FundSource account, for example, is not making any management decisions other than perhaps which model do they feel like would be most appropriate for the client. That's pretty much it.
And many of these types of advisory accounts are actually invested in either mutual funds or exchange traded funds, and they are very often nothing more than a shelf product, at your advisor's firm. That's probably what you're getting. So if you're invested in a mutual fund advisory account, you may have mediocre performance for the same reasons as the FundSource account we just mentioned. And again, much of the time, these accounts are the actual portfolio adjustments that may be handled by the firm itself, which also is much less work for your advisor.
So in that case, what is the role of a financial advisor if they have you invested in something like that? Well, I hate to say this, but they're really nothing more than a paid salesman. Because for these types of financial products, they're frequently have no involvement in the ongoing management of the account. So maybe they're earning an advisory fee for someone else to actually manage the assets, and the performance has been usually pretty mediocre. So if you have this type of an advisory account, you should be receiving a performance report periodically that probably shows some sort of 5-year rate of return that you've experienced. And assuming you can actually locate that performance report, take a second and compare it to the 14% 5-year track record our clients have experienced. Okay, obviously, past performance doesn't guarantee future results. We've all heard that. But making a simple comparison should provide you some insight to understand for your portfolio, if you have some room for improvement.
Now, before we leave this topic, we're going to spend some time on the decisions being made for clients by their investment firms. And this is just one more reason why we avoid advisory accounts invested in mutual funds and exchange traded funds. On the investments page of our website, near the bottom, we have a summary that is titled Pay to Play. Since you may not be able to view it at this very moment, the summary includes a diagram we constructed to show the relationships between most of the investment firms on the left of the page, and then also the products and service companies on the right side of the page.
And what we've listed there are 12 investment firms on the left, and there's plenty more that we simply didn't have room to show here, okay? And I'm going to run through these and understand these are purely in alphabetical order. The investment firms are that you can go see on this pay to place attachment. They are Ameriprise, Charles Schwab, Edward Jones, Fidelity, JP Morgan, LPL Financial, Merrill Lynch, Morgan Stanley, Raymond James, UBS, Wells Fargo Advisors, and the last was Vanguard. So there's 12 of them on the list.
So we didn't list the names of the product and service companies on the diagram, but it would include firms like American Funds, Putnam, Federated, T. Rowe Price, Hartford, JP Morgan, Allianz, PIMCO, Value Line, Virtues, Fidelity, et cetera, et cetera, et cetera. I could keep going on. These products and service companies create, manage, and distribute financial products that often end up in the accounts of investors. And sometimes these funds are chosen by the investor, and sometimes by the advisor, and sometimes by the advisor's investment firm that they're affiliated with. So these investment firms have all disclosed information explaining their financial relationships with these products and service companies, like we just mentioned.
So on the second page of that summary called Pay to Play that's on our website, we provided you with a variety of different web addresses that we easily found from each one of these various investment firms. In fact, we found at least one investment disclosure for all of them. We even found several, for a couple, I should say more than one, from Merrill Lynch, Morgan Stanley, and UBS. Now, before we go any further, when you open up this document on our website, there are links on the second page that you should be able to just click on, and it will take you directly to the disclosure posted, that disclosure document or comments posted by each firm.
If that link is no longer working, or if you want to see the disclosure information for an investment firm we didn't list, you can actually do a Google search and enter the company name along with the term mutual fund disclosure. So to search for the most current disclosures for Merrill Lynch, the search phrase is Merrill Lynch Mutual Fund Disclosure, or Morgan Stanley Mutual Fund Disclosure, or Edward Jones Mutual Fund Disclosure. I could keep going on and on, but surely by now you get it. The company name and then mutual fund disclosure.
Now, whether you just click on the link on our pay-to-play little attachment on our website or go find these yourself, when you review the disclosures for each one of these that each one of these firms has issued, it's a pretty shocking peek behind the curtain about these financial relationships that have been going on, in some cases, for years. And many of these disclosures are actually included in the new account paperwork and other correspondence that's given to their clients when they open up an account with those firms. Now, the fact that they disclose all of this information to their clients and really to the public in general, that doesn't mean very many people ever read it, much less understand most of it, okay? Now, it's common knowledge that investment firms, that they will make recommendations and direct money to these types of financial products and services companies.
And as we mentioned, these disclosures provide an inside look at the payments flowing from these same product and service companies back to these investment firms. These payments are usually referred to as revenue sharing or maybe cost reimbursement, and typically come from the internal expenses we've explained and we try to avoid. So, for example, the 14 mutual funds in the fund source model we just discussed have an average internal cost of 0.79%, which means someone with $1 million in this model is paying $7,900 per year in internal costs for those 14 funds. And that $7,900 cost is flowing into these coffers of the various product and service companies. And part of it is making its way back to the investment firms that made the decision to invest in those same funds. These people are spending your $7,900. You could be taking a cruise.
Exactly. And by reading some of these disclosure statements, it's surprising what you'll find. Some investment firms that you read, they will openly admit that they will not even include investments like mutual funds or annuities and certain things on their platform unless they receive money back from those same companies. And let me repeat that so make sure you understood this. Some investment firms will not include investments like mutual funds, annuities, and various things on their platform unless they receive money back from those same investment product companies.
So this whole process is called pay to play because these product and service companies have to pay for their investment products to be available at or maybe recommended at these investment firms. It's kind of like the advertise or the companies that pay to have their sugary cereal at the eye level of a kid in the grocery store, okay? Because they know the kid's going to be like, oh, there's a sugary cereal, I want to buy it. So they know what they're doing here. And same thing going on in this situation. So one investment firm disclosed receiving $377 million in a single year from these product and service companies. $377 million.
A lot of money.
Some of these disclosures include the term conflict of interest to describe these arrangements, with one firm, Merrill Lynch, mentioning it 14 times. But conflict of interest does not sound like a warm and fuzzy word.
No, it kind of rubs your fur the wrong way when you think about it. So you're listening to this going, why in the world are they talking about this? So what you need to be concerned about is if your investment firm is making decisions in the best interest of you, their client, or making decisions based upon which product and services company is going to send them back the most money. So this is where the possible conflict of interest comes into play. And it's just one more reason why we try to avoid advisory programs that are invested in mutual funds and exchange traded funds.
So, does your financial advisor know about these pay-to-play relationships between their firm and these various product and service companies? Of course they know. Has your financial advisor ever pointed this out to you and directed you to the firm's website to read about it? Of course they haven't. If they have your portfolio invested in their firm's mutual fund advisory program and their firm is deciding which funds to select for that program, reading this disclosure information may cause you to question if the investment firm is making decisions to benefit the client or to benefit the investment firm. So if you're interested, take a look at the document called Pay to Play on the investments page of our website to see for yourself what we're talking about.
And again, if there's some company that you're interested in, we didn't happen to list, you can Google up their name and the term mutual fund disclosure, and you should be able to find it. Now, as we go through this, understand that we don't just sit around and look for things to criticize. No one's paying us to explain this to you. We're explaining why we do certain things and why we avoid mutual funds in advisory accounts like this. What we think you need to understand is there is a potential conflict of interest when your investment firm and how they're managing their money and how many of these firms have actually admitted that. So don't shoot the messenger, okay? Again, this exists because your investment firm is receiving these payments from those same product and service companies to whom they are selecting to manage money for their clients. And this happens while your investment firm is also charging you a fee to make these decisions. Seems kind of strange, but this is what they're telling you.
Now, all of that may not be a surprising revelation to you, but does it make you question the advice you've been getting when it comes to mutual funds and annuities? In our opinion, these relationships probably explain part of the mediocre performance that many investors have gotten from their mutual fund advisory accounts. The only reason why someone may continue to stay invested in something with a mediocre return is their advisor either doesn't have an alternative or is a good salesperson, or maybe both.
And and one final comment about a conflict of interest before we move on. Have you ever received an invitation, most people have, to one of these investment workshops at the nicest restaurant in town, like maybe Ruth's Chris or Fleming's or something like that? And more than likely, if you did, that's being funded by some, let's say, an annuity company, probably, who works closely with the advisor who invited you. This is just one more example of a possible conflict of interest. And it should prompt you on the question about, is the advice that you're getting, is it really in the best interest of you or maybe the person inviting you?
Yeah, because that mutual fund is paying for your steak.
Yes.
Our team receives various offers to help us fund certain things we do, and with the hope we'll direct our money to that particular product or service company, okay? We get these offers just like every other advisor. But we want our decisions to always be in the client's best interest, and we don't want to feel obligated to make recommendations based on who may be covering our expenses, who's paying for your steak. So we don't receive any type of reimbursement for the events we host and these pod classes we produce, okay? Nothing. We get nothing for doing this. It's just for our joy and pleasure to entertain you and educate you. So we've covered a whole lot in this podcast, and here's a couple of things to ponder before we close out today.
So number one, we're glad you're listening to us on this podcast because this really is the most convenient way for you to hear what we're sharing and to learn a lot of things that you probably don't know but need to know. You're also welcome to join us at one of our live in-person workshops we conduct, and it's in the conference room of our building, which is Landmark Center. It's located at the Paper Mill Road exit behind the Exxon station, if you know where Paper Mill Road exit is. These workshops, they'll last about 2 hours. We try to have a light meal, have some fun. There's no cost obligation, but seating is limited, so you need to make a reservation.
And let me just mention, I thought you were done. Sorry.
Well,
I was just going to mention that our meal's not paid for by anybody but us.
That's true. We just pay for it with our little credit card. Now, on the workshop page of our website, theorganizedinvestor.com, you'll find the dates and the times. Megan even has this great little video that talks about, what the workshop's about and some other things. And there's also a way there to reserve your seats right on the website.
Last, our favorite part of these podclasses is getting to tell you that the rates of returns we've shared are for informational purposes and that past performance is no guarantee of future results. The returns for each of our client accounts can also vary based on the client's individual circumstances, such as when they start their account, what their investment objective is, et cetera, et cetera.
Now, these rates of return for our advisory clients, they were actually compiled from a month-end performance report for each of those 190 accounts, respectively. And it's really way too much information to try to place on our website in any sort of an understandable way. So in addition to covering this summary information with you here, we're more than happy to share this with you in a face-to-face meeting at our office or maybe a Zoom call, which might even be more convenient. In other words, we've got lots of boring documentation to back up everything we've just gone through. And we're happy to cover it with anybody that might be brave enough to sit down and go through it with us. We're happy to.
And you know what? Please feel free to contact us with any questions you may have. I'm going to send the hard ones to my dad. I'm going to take the easy ones. But anything you have, we are here to help. Also, be sure to follow us on social media, YouTube, LinkedIn, Twitter, and save us to your favorite podcast player to receive reminders of future episodes. We have more to share, friends, which means you have more to learn. So join us next time. And as always, thanks for listening, and class is dismissed.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or TN Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. The Organized Investor cannot accept trade or account instructions on or through this platform. Please contact us directly at contactus@tnwealthmanagement.com or 865-415-2060 to place a trade or for trade or account-related questions. Brokerage and advisory services are provided by TN Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by TN Wealth Management for educational platform purposes.